Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, April 13th, 2026. Economic news last week, same thing is going to happen this week. All eyes focused on inflation. So we had other economic gauges that came out. We'll talk about it, but clearly the key, what moves the markets right now is inflation and expectation of future inflation. So last week on Monday, we had the ISM services number. It came in a little light, but still really strong. So it was at 55. The expectation for the March reading was 54.0. 50 is the demarcation line between expansion and contraction. So services, very solid, no question. The next day on Tuesday, we got the durable goods orders. There was a February reading, a little worse than expected. The expectation was positive 0.4, came in minus 1.4. It's a number that bounces around quite a bit, so not much to take away from it, unless it continues on every month. But then on Thursday was a big day. So initial jobless claims, we get that every week. That was a little worse than expected, but still really good. So it's 219,000. Expectation was super low at 200,000. Because we've had such a stretch of outperformance, meaning less initial claims than expected. So consensus got aggressive. 219,000 was the number, which if you look 5 months ago, that would have been a really good number. So, but on top of that, we had core PCE that came in and PCE headline number, both about the same. But core PCE month over month for the month of February, which is key, the Iran war starting 6 weeks ago. That was right at the beginning of it, so not a lot of impact. But core PCE for the month of February was a positive 0.4%, exactly on the head for consensus at a positive 0.4% month over month. We had personal income that was released also for February. That number was disappointing. So the expectation was personal income to grow 0.3%. It actually was down 0.1%. Again, not sure. It's a 1 month data point, not sure what to read into it. Personal spending was, as expected, really strong. For the month of February, month over month, up 0.5%. That's exactly where expectations were. And then Friday, more inflation numbers. CPI core number that came out. Now, the CPI and the PCE, the personal consumption expenditure, we discussed both of those. The PCE, we put that out because the Federal Reserve uses it. That's their preferred measure of inflation. CPI is the number you most often hear in the news when people refer to inflation. One of the differences between CPI and PCE happens to be energy prices. So for the CPI, energy itself, just energy, not all the tangential flow-through impacts that higher energy or lower energy costs might have. But the energy components are about 9% of that index. For the PCE, which is what the Fed uses, it's only 4.5% to 5%. So significantly higher for CPI than PCE, which explains why the CPI number, which was reported on Friday, looked pretty high. So the inflation, the headline number was up 0.9%. That's month over month. For the month of March, that's what was expected. The core, however, month over month, was up 0.2%. It was expected to be up 0.3%. So this again not at the very beginning, but kind of early days in terms of what's happened with the Iran and the oil price increase. So certainly impact here, but not worse than investors expected. That is a good point. Also on Friday, we got the Michigan Consumer Sentiment number. I was very moved to just delete this one from our series because we try to stick to economic data points that really mean something, that if they're up or down, investors notice and it moves the markets. The Michigan Consumer Sentiment number is becoming almost laughable. Just over a year ago, let's call it 15 months ago, it was at 70 and now it's at 47. It keeps going down every month, but consumer spending keeps going up. So completely disconnected from reality. So let's just say this will probably be the last time we'll even mention it. So last week, inflation expectations did move up, but not tremendously. We told you got PCE, CPI. The expectation for future inflation went up a little bit, but not much. So the prior week it came in at 2.34%, the expected average inflation rate for the next 10 years. It came in at 2.36 on Friday, so up 2 basis points. It's higher than we had been running prior to the Iran conflict, which was down in the low 220s. Let's just call it 222, 223. So definitely higher, but clearly the market, I'll use that word, the market thinks the inflation that we're seeing right now, the energy price increases, as transitory, not to have lasting impact. Will they be right? Not sure. But we'll say this. What we've seen that has driven clearly inflation and expectations higher is the oil price spike, Iran, U.S. So here we're just showing a chart of where oil prices, this is WTI West Texas Intermediate, it had spiked up near $120. I think peak was 117 or so. And it's come back down. It's barely under 100 as just before we recorded this. But bear in mind, in 2022, we're actually a little bit higher than this, and for nearly half a year. Here's a real important part about inflation. So inflation got out of control, out of hand, worse than expected during 2022. I believe it was June of 2022, CPI peaked at 9.1, 9.2%. So what's the difference between now and 2022? Oil price surge, absolutely identical. But here's the biggest difference, and here's why we think we don't have a repeat of what we saw in 2022, and that is money supply. Back in 2022, where we're coming off COVID, and the administration in power at that point had just opened the bank and just flooded the market with money. Not saying that was good or bad, but most definitely that is what accelerated inflation. So we're showing here a chart of M1 and what happened in 2022. You can see it was just bumping along, modest increases, and just an exponential move up, and it just kept going for the next year and a half. Now it's tailed off, and we're not seeing that increase. So we'll say this. Inflation expectations, not sure where they go. U.S.-Iran conflict, not sure. But as long as the issue is confined to oil and we don't follow that up by just flooding the market full of dollars, we have a decent chance of keeping inflation relatively in check despite higher oil prices. Another data point last week, Federal Reserve Bank of Atlanta, they have been taking down expectations for first quarter GDP growth almost every time we do this. It goes down. It had been at 1.6% week before, down to 1.3%. Still be a solid report if that's what happens, but certainly their expectation has been falling. Now, the month of April, near the end of the month, 20th, 29th, we do have another Fed meeting. There's almost no chance of anything happening either way, hike or decrease. But the thing that has certainly changed over the last few months, and if you've been watching this, you would, I'm sure, remember, the fact that the real argument 2 to 3 months ago was how many cuts this year? 2, 3 cuts, wasn't sure. Now there is absolutely no consensus. Well, almost a consensus on the guess that there won't be any change at all from the current target level of 3.5 to 3.75% Fed funds rate. There is 32% odds of 1 cut, 5% odds of 2 cut, but there's also 14% odds that we'll get at least 1, possibly 2 increases by the end of the year. So market participants clearly, conviction level very high 2 to 3 months ago. Today, no one's really sure how the Fed is going to respond to the current crisis. So we gave you the economic data for last week. As I went through it and just kind of keep it a mental note, it kind of seemed like maybe more negatives than positive. Not to the stock market. S&P 500 up 3.6% last week. Mag 7 came roaring back, up 5.2%. And the 2 laggard style factors, growth and large cap, both outperformed last week, both outperformed value and small cap. Internationally, actually, international had a better week than the U.S. Developed markets ex-U.S. up 4.2%, and emerging markets up to almost 7.5%. Both of those index on a year-to-date basis beating the U.S. Now, the U.S. in terms of the S&P 500 after the nice rally last week, nearly flat for the year, down 7 basis points. So developed markets and emerging markets have both outperformed the U.S. significantly on a year-to-date basis. Fixed income last week, solid week. We had very little movement in yields. 2-year yield flat. The 10-year up 3 basis points. But the Bloomberg U.S. Aggregate Bond Index up 33 basis points for the week. Economic activity this week. So we have existing home sales. It's another one we should probably remove because really doesn't move the market, but existing home sales last month, the month of February, came in at 4.09. They're expected to be down a little bit from that at 4.01. Tomorrow will be interesting. PPI, Producer Price Index. This presages usually the inflation measurements that we see in PCE and CPI with a couple of months lag. So tomorrow, PPI month over month, the expectation core is expected to be up 0.5% month over month, and the headline number is expected to be up 1.2%. So the difference there, of course, being the fact that energy prices are considerably higher. Also, later this week, as we do every Thursday, we have another initial jobless claims. Last week, again, recall, 219,000. Expectations have come up a little bit this week at 215,000. So that's it. We thank you for attending our weekly economic wrap-up. We'll look forward to seeing you next week. We thank you.